Okay, so we're going to go back to um, financial management. Well, we'll start from the beginning and then work our way through, particularly for the, I'm sure that a number of persons may have had questions regarding the formulas. All right, so chapter one is pretty much theory. So we're talking about the cycle of money, participants in the cycle, common objective of borrowing and lending. So just a quick overview. When we talk about sole proprietors, what would be some of the, and of course I gotta pick on you because you're the only one here right now. So, and Kendra, you can answer as well. So Kendra, you can answer as well. So give me some advantages of sole proprietorship.
Oh, we did this one already. Tax purposes.
Tax purposes,
Um,
You have tax purposes, some advantages of sole proprietorship.
well, it's easy to set up, not as a form of a corporation.
Right? So expenses are low, easy to set up, tax purposes. What are some disadvantages of owning a sole proprietorship?
Business is not perpetual.
Mm-hmm,
When you die, the business dies.
mm-hmm.
You're at risk to most of the liability.
You're at risk to most of the liability, correct? So when it comes to profits, the owner pays their personal taxes as well. So when it comes to profits, when you have a sole proprietorship, instead of paying corporate taxes, you pay personal taxes on corporate, which of course is higher than the corporate tax. All right. Partnership, we have agreements between partners are easily formed. So it's easier to form a partnership. Well, it's easy to form a partnership as it is for sole proprietorship. Once you two come to agreement about what the terms are, that's what is actually set in the plea. A large amount of capital usually available to the business. So whereas one person would be bringing in the money, now you have two or more persons who are bringing in money to start the business. And some disadvantages are some of the assets of the general partners are now commingled with the assets of the business. So what that means is that if the business has an issue, gets sued, shuts down, then the partner is liable, just as it is in the sole proprietorship. Corporation, the advantage is that the business is a legal separate entity from the owner. So when you open it, someone can sue the business, but they can't touch your assets. So you are pretty much not liable. In that regard, you have access to greater capital for your business, particularly in the United States. With the corporations, you are able to apply for loans, grants, whatever you need. And oftentimes, depends on what party is in, they are favorable to corporations. Some disadvantages are most difficult business operation to form due to charters and other legal documents. You have double taxation of company profits, first at the company, then at the owners when distributed, and then often corporations are the most regulated form of business. All right. We talked about the agency problem. Remember anything from the agency problem? Principal agent relationship. What do you remember about principal agent relationships? Can't you get an answer to? Principal agent relationships.
Getting the agent to act in the best interest of the company.
Right. So getting your agent to kind of come into agreement with the principal to make sure that the agent is doing what the principal requires. What are some risks that are involved with principal agent relationships? Right. Some risks.
When not fulfilling the contract.
Right. So you don't fulfill your contract, and so the agent can be the cause, sorry, of one reputational risk. So what happens is if the agent is stealing money, then everybody just say, you work for Fidelity. With Fidelity, you say, what is it? Fidelity is thief, right? Meanwhile,
They say Scotia Steve.
well, yeah. I gotta play the competition too because I worked for the two. But you know, Scotia, yeah. Anyway, so they say that if they say they will never say the agent's the thief, they just say Scotia thief, right? So what happens is you suffer reputational risk, and of course, with the reputational risk, if they steal, then you suffer legal risk. Outside of reputational risk and legal risk, you also face people risk, which means that whenever you hire people, they leave, they do whatever they want to do, so you have all these risks involved. So all of these are costs to the business, or the business, they increase their insurance to cover these risks. And so whenever you have principal agent relationships, you must always ensure that your agent is working in the best interest of your principal. How is this possible? How do you ensure that agents are working in the best, are working in the best interest of the principal?
Making sure they're incentivized properly, they're motivated, they feel valued
Mm-hmm,
in their workspace.
mm-hmm.
Yeah.
All right. So what happens is now when you pay them right, and sometimes you pay them right, they still do whatever they want to do. Another thing is you make sure that the contract is right. You make sure that all of the terms and agreements are there. They have non-disclosure agreements in place. They also have, what's the next word I'm looking for? They have non-disclosure agreements in place, and they also have code of conduct in place, and they follow the manuals. All right. So once all of these are in place, then we ensure that the principal and agent problems or relationship remains intact. All right. So that's pretty much what covers corporate governance. Do you remember what corporate governance is?
It's basically the outline of how the outline of how a company should be run.
Okay, so outline of how the company should be ran, but what more about it? How does corporate governance tie in with the board of directors? Let me ask Kendra 1 second. Kendra, can you hear me? Oh, I know you said you're only listening, right? I mean, I know you're not feeling too well, so I'll just kind of talk. Okay, or you want to answer? You could answer.
Yes, I can hear you.
Okay, good stuff. All right. So corporate governance, how does that tie in with board of directors? Oh, okay, she can just hear me. Okay, so that's fine. All right. So corporate governance ties in with the board of directors because this is what governs the actions of your board of directors. So not only are your agents can act out, your board of directors can also act out. So what are some stipulations based on what's the name of the act that the United States has that governs corporate governance? There you go, Sarbanes-Oxley, right? So Sarbanes-Oxley has 3 main requirements. What are they?
Yeah.
No problem.
I'll try. Sarbanes-Oxley Act govern the way accountants did their audits.
Right.
To
Hello.
reduce.
How you doing? Let me get your name. Rashay. Got you. Okay, good stuff.
To make sure that the accountants are doing their reports and their statements
Mhm.
correctly and adequately up to the GAAP standards that they would have set in place.
Okay. No, right. So the CEO and the CFO attest to the fairness of these financial reports. So not only do we ensure that the auditors are working properly, we also ensure that the CEO and the CFO sign off on it. So as soon as the CEO and CFO sign off on it, they agree that 1, it is correct and accurate, and 2, they agree that they've given all the information that they know. So if there is any error inside these financial reports, then the CEO and the CFO then next are on the line. Why is it that they then next on the line? How does this protect the investor?
Because they're vouching that the company is not, going against any of the ethical rules and ensuring that all of the users of the information is getting the full story of the full outline of how the company is running.
Right.
If it's profitable, if it's going down,
No, you're good. You're good. So if the company is going down or if the company is profitable or whatever, it gives your investor all of the information that they need to make a sound decision. All right. You don't want to hide anything. You want to make sure that everything is exposed everything in terms of even lawsuits or money owed to people. You need to know that as an investor, so you'll know if to make investments into this company. Now, financial statements. All right. So with financial statements, the first one is balance sheet. What is the purpose of the balance sheet? Rashid, there you go. Like every time to cool down and calm down and relax and breathe. What's the purpose of the balance sheet? What does it show? What does your balance sheet show?
Long-term assets, short-term assets.
What anybody knows the accounting equation?
Assets, that's equals,
Liability
shareholders
and
equity plus
shareholders'
liabilities.
Right? So essentially what the balance sheet shows is how this balances to this. Because all you have to remember is that your assets are gained by either you borrow money or somebody gives you money. Okay, you either borrow or somebody gives it to you, that's how you get your assets. Everything you own now was received by either you borrow, you borrow or you bought it yourself. Nobody here steal, nobody, okay? So, right, so either you borrow to get it or you purchase it yourself out of your own money, okay? So you have your assets equals liabilities plus capital. Under your assets, there are two types of assets. What are they?
Short-term and long-term.
Short-term and long-term, what do you call them?
Current assets,
Mhm.
long-term assets.
So you have fixed assets and your current assets, right? Fixed assets and current assets. And when you look at your balance sheet, and you always understand that your fixed assets, your current assets, even your fixed assets are in order from what to what?
Liquidity, so.
Most liquid to least
Most of it's
liquid,
the least.
right? Why is that important? Why is it important to determine most liquid to least liquid?
In the event that the company, gets the cash out or it's failing and they need to pay their debtors, then that's the.
Right, that's the order in which it goes in, right? All right, so perfect. All right, so now your liabilities are also in the order based on what? On what range? So it's not liquidity, but it's based on what? I guess it's kind of liquidity, but we know what your liabilities or things you owe, you're talking about what?
What you need to pay right now.
Right, so what is due right now, and then what is due later on? Okay, everybody good? We clear? We clear in person or we clear online?
I mean, it's the same for me.
Yeah.
Same for y'all?
Yeah.
All right, we can see. All right, good stuff. You can see. All right, so liabilities and owner's equity. Capital, of course, there is also a certain way that they are listed as well. Income statement is your second financial statement. With your income statement, what does that tell you?
If the company made a profit within that year.
Okay, so how does that lay out? How do you lay out? What's the first thing on your income statement? Sales or revenue, right? So you figure out in your income statement. Thank you. Yes, thank you. You figure out in your income statement, one, how much money we made all year. So that's before you look at any expenses, what makes up your revenue or your gross profit? Called your sales, right? So all your sales make up sales of what? Your inventory times your price. Whatever you had and whatever you sold, that's your price, all right? That's your sales. Now, when you look at your sales, the first thing that comes out is what?
Discounts and all of that stuff.
When you, so you have your revenue, which is your first line in your income statement. The first thing you deduct from that is what?
Discount to cost of goods.
Cost of goods sold, right? So your cost of goods sold are, it's the cost of the things. So these things that you sold, how much did they cost you? So you take that out first. After you take out your cost of goods sold, you take out your expenses, which are your wages, utilities, other expenses. So after your cost of goods sold, you subtract all of your expenses. Okay, when you remove all that, what's this figure here?
Gross profit.
Gross profit or what? What's another name given to gross profit? I can tell you. What's another name given the gross profit?
What that is begin with?
E.
Before interest and taxes.
Right, so you have earnings before interest, taxes, what else and what else? Depreciation and what? You would often see this term. Good job.
Earnings before interest, depreciation, taxes. A,
Allowances,
like
Yeah.
bad debts and stuff.
allowances, right? Yeah, for your bad debts, all right? So your earnings before interest, depreciation, taxes, and allowances. Why don't you count them in this first go round?
They're not part of operational expenses.
Right, so they're not part of operational expenses and they have not yet been expended, essentially, outside of your, so all these are paid. All these already accounted for. Whatever's coming afterward are things that are not yet accounted for, but you still can't count them.
Mhm.
All right, so the first one being depreciation, next being interest and taxes, next being taxes. I mean, interest and taxes, of course, and then earnings before taxes. You subtract your taxes, and if there are any allowances, you take out allowances, and then you have your what?
Yeah.
Net profit, or net income, or your net loss. All right, so that's your income statement. Your next statement is your cash account. Your cash account accounts, of course, for your cash flows. Money in, money out. There are two sides of the cash flow account, and they are what are the two sides? Debit and credit. What's on your debit side?
Debit is money coming in. Credit is
Cash
money
in.
that leaves.
And credit is money out. All right. Remember now, cash is a what? It's an asset, right? When assets decrease you,
Credit,
when assets increase you,
debit.
debit, and when assets decrease you, credit, which is why when money in, which is assets increasing, you debit. All right. What are some examples of assets or cash in?
Capital.
Revenues, capital, owner's capital, and what else? Loans. Okay, loans. So some cash out would be planned, whatever you're spending on plant and equipment, land and building, trucks, wages, utilities, anything like that. Okay, so we getting that. Cash flow identity. What is the without looking, what's the formula for cash flow from assets?
Like on the actual cash flow segment,
No, that's just the formula.
I can remember how it worked on that.
So you have your operating cash flow minus your net capital spending minus change in net working capital. Remember that? That'll be on page 18 of your stuff. All right. Net working capital out of your head. 5, 4, 3, 2, 1. No. Net working capital. Think about the wording, working capital. What is working capital? No, capital that you work with, right? So
Yeah,
what capital you have to work with?
Like equipment.
No, what capital you have to work with? Not that kind of working. What kind of capital are you working with?
Inventory.
Right. So how do you determine your, current assets minus current liabilities is your net working capital. So what you have once in stock minus what you owe or who owe you is called your working capital. All right, so that's what you have to work with. You can't count what is owed. You just have to count what you have in your hand. That's what you have to work with
Mhm.
day to day. All right, so that's your net working capital. Your cash flow to creditors is what? Your interest expense minus any net new borrowing from creditors. So what you owe them minus anything you borrow after you owe them money. That's your cash flow to creditors. All right. We good? No? Hmm? Got you. All right. Because you remember you told me, okay, we good. We got this. All right, change in equity, ending common stock and paid in surplus minus the beginning common stock and paid in surplus. All right. This is page 19, right on top. Cash flow to owners, dividends minus net new borrowing from owners. Right. Answer some questions right now. So it says as financial statements, chapter 2. Now, we're gonna go through some examples before we go. But we ain't leaving right now, but just saying before we go, we're gonna go through some examples. So because in the exam, I promise you, we're gonna throw it every other way. And so we just want to make sure you have the concept so that when you do see it, you know it from left and right, back and front, bottom to top. Let's look at financial statements again. Oh, they printed this twice. I think they did. Sorry. Does anyone need chapter 2? Yeah? Anybody in the hard copy chapter 2? You don't read slides. I got you. No problem. All right. So let's look at chapter 3. Time value of money. This is where a good chunk of your test is going to come from. Again, your test is next week. So you want to be in place and be still at 6:30. Right.
Just online, or we're coming here to do it as well?
Pardon?
We're coming here to do it as well, or it's online?
No, it'll be online.
Okay.
It'll be online. Okay. All right. So, pardon? Moodle. Yeah. On Moodle.
I need to get into Moodle, right? So
You didn't get in? What did it tell you?
I don't have the link or the access for it.
No? I didn't send it to you?
I got the slides from you and then the book for the link.
Okay. So I'll confirm today. All right. So let's talk about future value and compounding interest. Future value and compounding interest. All right. So when we talk about the single period scenario, what is the equation for future value?
Present value.
Plus present value times the interest rate.
Looks like that. Pardon? Or you would see this.
Present value times development, yeah.
But that's multiple. There's multiple.
Yeah, that's multiple.
And this is, of course, single thing, right? What makes it multiple? That right there. Okay. So what happens here is with your single, you determine your future value by saying, what's my present value? Plus what?
5,000 as the interest rate.
So if the interest rate is 5%, what would you say?
Oh, 1.05.
No, just be 0.5.
Oh, you do
Right.
a single.
Right, just single, right? If it's that, you would get what? What's your What does your calculator say?
250, 5,250.
Right? What's another way we can write this? Short form.
Oh, yeah,
Yeah? Do you know we got this?
that's, the second, that's the multiple equation,
Hmm? Not particularly. It's the multiple equation without this.
without the end.
Without the end, right? So what happens is for single, you get your 5,000, you multiply it by 1.05, which is actually this. 5,000 multiplied by, and you would write like this, 1 plus your interest. No? Because when you're doing equations and you're trying to make an integer or a whole number, you always add 1 to your decimal point. Otherwise, it'll always be a fraction of whatever your primary number is. So when you get 5,000 times 1.05, you're multiplying the 5,000 by itself, and you're also multiplying the 5,000 by the 0.05. We good? You sure? You good? All right. So you should still get 50 to 50. All right. Now, when you're doing the multiple, it's the same equation. Only thing is you are adding your multiple here. So if it's 5 years semi-annually, how much to go right here? 5 semi-annually. How much you go up here? What number should go up here? 10. Why 10?
You got semi-annually.
Semi-annually meaning you're paying twice a year. What happens is whatever number goes in here is how many times are you going to be paid interest for the period of time that you have your investment. Okay, so what that means is then you have to understand and remember, if I say that we're paying it biannually, you're thinking what?
Twice a year,
Biannually,
like every 2 years.
every 2 years, right? Semi-annually, twice a year, fortnightly,
Did you say?
fortnightly,
Fortnightly, 4 times a year each quarter? Fortnightly.
fortnightly,
Every 4 years?
every 2 weeks, right?
I've never heard that one.
A fortnight is 2 weeks. So we have fortnightly is every 2 weeks. So when you see it in your exam, just remember.
Now I know.
Yeah.
And
So your
for-
fortnightly will be seeming as semi-monthly or pardon?
FORT.
FORT, fortnightly. All right. So when you see it on the exam, just remember it's every 2 weeks. All right. Again, if you see monthly, it's 12 months, obviously. And then, so these, just remember these various terms so that when you get in your exam, it comes quickly. And always remember, you always multiply it to that power, because it's always however many times interest hits, that's what you are actually calculated. All right, so work this out for me. I have an investment that I am going to be paid. I want to put $5,000 into an investment. I want to be paid in 7 years from now, and they pay me quarterly. What would be my balance in 7 years?
What's the interest?
At 3%. $5,000, 3% in 7 years paid quarterly.
$11,439.
$11,439. Tell me what you get, Rasheed.
get 61.49.
So you get 61.49. And
Okay,
you would
what's
get,
the interest or what's the total return?
It's the multiple period.
there's a total return, right? And you have 11,000. Let's go back to your 11,000.
11,439.
439 and
64 cents.
64 cents. All right. So tell me how you got it.
So 1.03 to the power of 28.
So you have your 5,000 to the power of 28.
No, 1.03.
Uh-huh.
Yeah, like that.
That's what you got.
Yeah.
So what did you get?
Let's see, adding in the quarterly.
When you say adding quality, what do you mean? What did you have? What did you put in?
I put in 5,000 times 1.03
To the power of
7.
7. You're right. So it's just 7 times 4 because it's quarterly.
Yeah, yeah,
Yeah.
okay.
Okay. So you're gonna double your money in 7 years. If you put it into investment, that pays 3% quarterly. All right, you always have to pay keen attention to that. How many persons have ever heard of this term here? EAR, effective annual rate. Your effective annual rate is how much you're actually being charged on your payment. So what happens is your effective annual rate will fluctuate because just because what's it called, a product may say 7%, you have to figure out how many times are they paying interest. Because 7% is not always 7% at face value. If they're paying it quarterly, that means that they're taking the 7, dividing it by 4, and then every time that interest hits, it's going to be done, it's going to be recalculated. All right. So what happens is at the end of the day, you may be paying 8.49%, just saying, right? So what happens is because this was always an issue with banks, particularly in the United States, whereas they would advertise this beautiful 7%, but don't tell you what the AP, what they call an APR, annual percentage rate is. What happened is persons would get these loans and be entangled with the bank because they didn't know what the effective annual rate was. So now it's mandated by law that whenever you get a credit card, they always show you what the EAR is, even though they show you what the annual rate is. Because they're saying if you don't pay your bill, this is what exactly you're going to be paying at the end of the year. If you don't pay it in full, all right? So it's a part of consumer protection that they do, okay? But we're also going to be calculating how to calculate EAR so that when you get your bill or when you get your credit card or whatever your lending facility is, you will always know what it is that you are actually paying back. You have a question? No? You see how you're asking us, right? Okay, good. So what's the opposite of compounding?
Simple.
Hmm?
Simple.
What's the opposite of compounding?
The compound is the add and add and add.
Right? So what's the,
Subtract.
no. Compound is more or less multiply.
Right.
So what's,
So divide.
no. Okay, what's another word for divide? This is a D word. Don't cuss, but this is a D word.
Discount.
Discount, right? So opposite of compounding, when you are finding future value, you compound. When you're finding present value, you discount. Okay, so what's my calculation? What's my what you call the word? Formula for discounting or finding present value?
Future value
You already know if you're pay. Okay, let's go. Future value
times 1 divided into 1 plus rate and the number of years.
This has how it look. All
I
right,
never remember.
you remember that, right? All right. So help me out. I want to make 15 grand in 7 years. They pay me 4% quarterly. Calculate that for me, please.
Did he say the compound? No, wait. Did I say quarterly?
I think so. I mean, as a G.
I think I meant to say quarterly.
All right. What did you get?
$5,002.15.
$5,002.16. Oh, $5,002.16. What did you get?
Same.
Same thing? All right. So what does this tell me? That I need to find an investment. If I put $5,000 a day in 7 years, paying 4% quarterly, I'm gonna get $15,000. Do we have any? So that means every year they're gonna be paying me what? 16% interest. Now you see why credit card companies make so much money. Because they lend you $5,000 on your credit card, they tell you pay only a minimum over the rest of the year. Which you spend $5,000 on in 7 years, you're gonna be paying back $15,000. If you don't.
Where you got 16% from?
This is 4% paid.
4 by 4, okay.
Yeah, 4% paid quarterly. So this is your typical credit card on the lower end. Right? So that's why you must always, and also if you have a goal, if that you want to save $15,000 in 7 years, and you only got 5,000 to put up, you need to find an investment that pays you 4% every quarter. Now, I don't know what investment does that, but hey, good luck on that, right? All right. So with that said, then how do you solve for an unknown interest? And this is your other part, I guess. But you also have to follow online, right? You can follow us online. Yeah. All right. Okay. All right. So here's where we are. Well, two dropped because they said they couldn't understand online, but then they didn't come to the- Yeah. All right. So one equation, 4 variables. One equation, 4 variables. Sorry. Help me find the rate if I give you this. 10,000 is my present value. My future value, I want to have $21,000. I need $21,000 in 8 years. That's my N. What investment do I need to invest in on an annual basis? I won't even complicate it. What's my interest rate? These are my variables. $10,000 I have now. I need $21,000 in 8 years. What's my interest rate? First, let's go with what's my equation? Yay, okay. What's my equation?
It's future value divided by present value to the power of 1 over the number of years.
Future value over present value.
To the power of 1 over the number of years, minus 1, I think. Right, all right.
Correct. So your future value will be your present value, your 1 over n. So what you're saying is you're taking what my future value is, you're comparing it against what I have now in my present value, and you're putting it to the power of 1 over n. Why are you putting it over 1 over n?
Is that the same answer that you said earlier?
Because discounting mean? Or no? What answer did I say earlier? So tell me why you're doing this. Why are you putting the 1 over n?
Divided by 8. Can't it, I'll give it a percentage.
Not really.
No, it's 12.5.
Because what you're doing is you're taking it and you are, remember your math term in school? When you're taking it and inverting it.
Oh, when you flip it.
So n inverted is 1 over n. Because you're flipping it just to try to find your rate. So this is where you go back to when I learned what I learned in math. Again, when I'm gonna see it again, there we go. So your future value over your present value, 1 over n minus 1, you get what?
9.7%.
9.7%.
So can you use present value calculators?
You can.
But
I
some
think-
questions would be particular to this equation though.
Correct. Some questions you will have to find your interest. All
I
right,
mean, like it would, on the exam, would it say that?
what's my
So-
interest rate? Yeah,
I mean, use the formula.
no, we won't tell you which formula to use.
Oh, okay.
You just gotta know which formula to use
Okay.
and find it quickly.
It's only being a test, so we have to search it up too.
The formula, which means search it up.
The formula be there.
No, but the test is open book.
Okay.
You just gotta know how to maneuver.
On Moodle, is it gonna be like, A, B, C, D, or we have to do, type in the work in and all that stuff?
No, it'll be ABCD.
Okay.
Yeah.
So present value calculator.
But just remember also that a part of your grade will be tests and stuff that aren't on Moodle.
Mhm.
So I go,
Switch it up. Okay.
yeah. I got it. Twist it. Right?
Mhm.
All right. So you get 9.7. So this tells you then that if I have $10,000 and I want to make 20, when I want to get $21,000 in 8 years, I have to find an investment at least that pays me 9.7% per year. If I want to get this in a faster time, what would I have to do?
Get what your investment in the past time,
Mhm.
less than the years.
No, I can't. Lessen the years. How would I lessen the years?
You need a higher interest rate.
If I don't get a high interest rate, at least I'll have to find an interest rate that pays me more interest payments over that 8 years. All right, because I don't need it, I don't really need it till 8 years, but I need to, or if I need it, 8 years is my maximum. And if I'm gonna do that, I have to increase the amount of times they pay me interest. That's also how you pay off your mortgages early, because you are making constant payments over the expected once a month, and that's how you get your money back. I mean, that's how you pay off your mortgage quickly. Does Fidelity allow you to do that?
Mhm.
Okay, more than once a year?
Mhm.
Okay,
As much as you would like loans to.
really
the loans.
good stuff.
So you beat the system like taking twice monthly.
Basically, yeah.
Yeah. See, they already brainwashed and tell you.
No,
don't
but
have it, right?
I'm not a loan officer, but for those that do get loans and they ask me
Yeah.
questions, I would always say, if you can afford it, put more on the principal.
Mhm.
Right,
than-
but do y'all allow that? Because there's
We
some
do,
banks,
it's free. You don't
Okay.
need- I think RBC is a penalty if you
right,
wanna.
there's some banks that don't
to
allow
pay it
you.
off, because you take it away, the money
Right.
that they're earning.
Mhm. So they will put interest rate on everything. every
Yeah.
month.
So it's like, if you get a loan, always put something on the principal. Reduce the amount of interest you actually be paying.
Okay. What rule do you use to double your money? What rule do you use to double your money? How do you use the rule of 72? Let me put it like that. How do you use the rule of 72?
What is the rule of 72?
Oh,
What is the rule of 72?
talk about it. Mhm.
Adding the rate of interest into 72, then to get an estimate of the period required to double sum of money will be calculated.
So if you want to double the amount of money, if you have $10,000 and you want to make this 20 grand, you want to know how many years to do it? You take 72, you divide it by whatever your interest rate is. So if you find a product that pays you 8%, it's going to take you 9 years to double 10,000, 20,000, but at 8% investment. Yeah,
Where does 72 come from?
that's just a mathematical rule, right?
So you always.
You always divide whatever the number is. You always take 72 and divide it by whatever the interest rate is. So take your current, so take your current time deposit at 1%. If I want 10,000 to 20,000, I'm gonna have to have that in an account for 72 years. Right? To double my money,
There they go.
to double your money. All right? So the key is, you realize now why savings accounts and stuff are never meant to make you wealthy as much as they're meant to just hold funds there until you actually could do better, right? Or to invest. All right.
Unless
So let me ask, sorry,
Unless you're a millionaire.
of course. So is the present value always less than the future value?
No, not necessarily, because value of money decreases over time.
Right. But no, you're saying that it's not always.
The present value,
Is the present value always less than the future value?
Not necessarily.
When would the present value always be less than future value? It'll happen if your interest rates remain positive. Now, if your interest rates get
I
negative,
thought I was gonna say the wrong thing, I was gonna say that.
yeah, but when will interest rates be negative?
What, in a depression?
In a depression, or like some banks now not paying any interest rates, like them people, yeah. So you know what, Fidelity, I understand, realize, but Fidelity always have this,
What's the word?
this, I would say grudge, but they got this feeling they better than people think.
Superiority.
Yeah, they got a superiority complex. And mine, Kendra is at RBC, and we don't want to be talking about RBC today, and Kendra can defend her bank.
Kendra, no.
Yeah, Kendra
Kendra
can
probably
defend her
up on
bank.
account of that Fidelity as well. She knows
Ken-
how to bottle
Kendra
that.
can defend the bank, and so we can't even allow that, right? So, let's look at it again, okay? So when a lottery prize is offered at $10 million, but will pay out a series of $250,000 payments over 40 years, is it really a $10 million lottery prize? So, with lotteries in the States, they pay you $10 million. They say, you win 10 million, and they're gonna pay you $250,000 over the course of 40 years. $250 a year
Okay.
for 40 years. Is this really a $10 million prize?
No, sir.
Why?
Because the value of money would decrease with time spent.
Right. So your future value is less than your present value, right? So that means then that over time, this money will be worth less because of inflationary pressures and all of that. All right, so let's go forward to looking at it's a lot of people. So we good so far? I mean, in terms of understanding present value, future value, all that. All hearts and minds is out. We good? We good? You know, sure. You sure? I'm very light. Okay, yeah, once you go back, you'll be good to go.
Problems, like working through problems, help me find,
Gotcha. Okay. So let's look at future value of multiple cash flows. All right. So multiple cash flows means then that what happens when you don't just put on this $5,000 at the beginning and let it sit over time? What kind of investment would you get if you put this money? If you put $5,000 now, in a year you put $2,000. Year after that you put $3,000 and all that kind of stuff. All right. Here's what you call, anybody is familiar with the timeline? Oh, well, not timeline, but cash flow stream. Before the book.
No.
Before you start the book, no? All right. So cash flow stream, it helps you to determine how much different payments over time. Like you said, your bank would allow you to make different payments, different principal payments over time. T, your beginning is always T what? Zero, because that's ground level. All right. So we have T1, T2, T3, T4, right? So there are, well, let's just go to 3 for simplicity's sake. So at T0, we make a deposit today. You always start with negative. Okay? Because you're working your way backward when you're counting. So you always start with negative, right? So your $3,000 is your beginning, is your initial deposit. In a year, you're going to put down 5,000. In year 2, you put down 7,000. Year 3, you put down 9,000. All right? And you work your way down. So what happens is every year you put in an account that pays you 10%. Okay, so this is an investment that pay you. You put your 10% right here between these, because between every year, from year 0 to year 1, you get paid 10%. Year 1 to year 2, you get paid 10%. Year 2 to year 3, you get paid 10%. Okay, we good? Cardia, you good? No?
Are we? Okay, we started off with negative, then we went to 5,000.
Right. Don't mind, this negative doesn't mean that you have a negative balance in your account. Just the
Right.
first payment deposit is negative.
So it wouldn't be an accumulation?
Yeah, you accumulate over time,
Okay.
but this is what you do. So year 1, you're paying what? You're getting paid what?
10% or-
$3,000 a year. Well, you're putting in your 3,000, and every year you're getting your interest on that what?
3,000.
3,000. So you, how do you work your future value? Give me a future value equation.
Times
Future value equals present value.
1.10 to the power of 3.
Make sense? All right. What's your next equation?
5,000 times 1.10 power.
5,000, and you're getting paid 10%.
1.1.
The power of 2.
Power of what? Why not 3?
Because he's
Why not 3?
You would the next year.
Right, and it means what?
the compound.
Why are we counting now?
Because we ready to fulfill that year.
Right, but, I mean, we just put in this year, so why not carry on for 3 years ahead?
Because it will be 3 years.
Right,
The
because
market
your
is
investment is
So
only a
it's the same-
3-year investment.
end date, yeah.
So no matter, but even though you put this money in year 2, you only get 2 years worth of interest on it. Year 3, give you what?
Power 1.
Because you have 1 year, right? Your last year, you get what?
Nothing.
Nothing. So your 9,000 just goes down. So what's this for first one? in year one, you're looking, well, for the period of your 3,000 being in there, and you're not taking anything out, you get $3,993. We agree to that?
Mhm.
Why? Does the book say that?
That was
Yeah,
actually good.
3,990.
I got you. All right, what's this money?
$6,050.
And the year three is, and you don't count anything but year four, so you add this right now. So if I find an investment, then I put in 3,000 year one, 5 grand year two, 7 grand year three, 9 grand year four. When I'm calculating all of them, what am I gonna get in return?
26,743.
And if I didn't, and if I just had this money holding, what would be my balance? If I just didn't save it and I put it under the mattress.
$24,000.
So I mean, over time, I would have made $2,743 because I made extra payments. Good. We good? All right. What's the future value of an annuity stream? What's the equation for that? Sorry, I have a 4-year interest. I have a 4-year, sorry. I'm gonna take this off. Oh. Everyone knows P/A stands for, right?
P/A.
Payment annuity
Pay
President
per
annuity.
annum.
per annum. Oh,
I need you to run me my cash flow stream and then work how much I'm gonna be paid at the end.
Huh?
Huh? Yeah,
like what we just did?
right.
How much years?
Oh, the same equation?
Yeah.
Oh.
Right.
Yeah.
Okay.
Yeah. 1, 2, 3, yeah.
You saying you want me to work it out?
Yes,
I'm gonna work it out.
yes. But no, you don't have to. You love that when you're on.
Okay.
You're missing something.
9% of it.
No, you're missing something. The first thing we said, your first payment,
Negative.
right?
Okay.
You're missing something else.
The,
There you go. Yeah, you'll get a point off everyone in that money off exam.
really?
Oh.
I mean, in the personal, in the, not personal, but in the,
Final.
yeah, because if I don't do the final on Zoom, I mean on, what do you call it? Yeah, I do. If I see everybody at 100%, I gotta find somebody to take off.
Wow,
points.
that's powerful.
You take second?
Sure.
Is it? Oh,
Why
okay.
they like I'm missing something?
The 11 supposed to come down,
Right.
right? The last year is supposed to be.
Yeah, so what you missing?
What am I missing? What? 10, 11. One more payment you missing?
You tell me.
I feel so.
Mhm.
It have to be, right?
So let's just take off this 5-year investment
And make it.
and let's just make it for investment.
Okay. That was. Yeah.
Out of what?
Make it
You
make
still have
sense.
5 figures.
Make it make sense. So.
Yeah, sorry.
4, 3, 6, 1.
Okay, go ahead.
Doing something wrong?
Pardon?
Or did we do something wrong?
No, go ahead.
Okay. Tree. Oh, you didn't do it right? 10, 19, 23. This one. All right.
I gotta use schedule.
Let me, you know what? Yeah, let me, yeah.
Excuse me 1 second, let me just get this call. Let me just
Turn my mind to
put this here.
Put this part this way. This one is that.
That's 1,000 or 10,000?
Where is that?
Out of 3.
1,000. That'll be yours to work out when she's done.
So I write, I finish.
So now the next part is taking that,
Oh, right,
subtracting
right.
with all of the R, I found out how much you made. So
Like, run your part out, or do we-
I don't think that's it. Company account.
You go ahead.
Did I write or wrong?
You correct.
Oh.
Sorry, you correct, yes.
You have to make sure.
No, you correct. Trust me, I tell you, a long time ago, it's been enough cost.
You might as well keep the.
So true. It's good.
Fred. Frederick Branch, right?
Founded.
Good, you know, he wants to come in.
He wasn't even checking for me.
Right?
Oh, nice right, tiny.
Yeah.
Yeah, you're right.
Cartwright. 13 Wood Street. Yes. Sorry, 13 Wood Street. Internet. Okay. Sure. Not a problem. Thank you. Okay. So why would you be looking for a future value of an annuity stream? Why would you want to know the future value of an annuity stream? Sorry. Like what? Go ahead. Let me finish give you this.
That ain't gonna make no sense to me right there.
Future value of an annuity stream. This is the equation for that, right? With the future value of an annuity stream, you would need to know essentially if I put this amount this often at this rate, what would I have in this amount of years? Why would you want to know that? What kind of scenario would you be presented with to know that?
Mortgage, right?
Not really. An investment of what type? So if you have a kid that's going to college and you just had a baby. Right, so you just had a baby, you wanna know by 18, if I put $200 a month in this particular investment, how much would this be worth in 18 years, 20 years, that kind of stuff. If you're gonna retire in 20 years, you wanna know if I put this amount as opposed to this amount, what difference would it make? Because you would be surprised the difference $50 will make over 20 years.
So insurance would be eligible.
Right, so the insurance and insurance for annuity. If you get an annuity, an endowment, right, an endowment, annuity kind of thing, because endowments are normally annuities, so that's really what it is, all right? So if you're making a payment of $2,000 a year at 8% for 10 years, you would go through this entire process manually like this. Year one, you take your $2,000 for the year, you multiply by that, and you have how many? 9 years left. Year two, you take the same 2,000 a year, you get your 1.08, and you keep working on that. When you're in your exam,
That'll be long.
yeah, you're gonna have all that, right? So what happens is, you would take your payment, what's your payment? $2,000 multiplied by what? 1 plus 0.08 by how many years? 10 years minus 1 over 0.8%. Okay, that's what you work, that's how you work it. Well, that's a max settle? No? So what happens then is when you do this, you are now calculating how much would it take for me, or what this $2,000 a year would be worth in 10 years. And that's how you work at your 10%. In 10 years, that $2,000 would be worth $28,973. So what's my uptick? $8,973 in 10 years. But that's the level of my investment, because that's what? 8% per year. You don't often see that in investments. That's why with annuities, because they have for such a long time, they offer a higher interest rate. Okay? How do you work at the present value of an annuity? You say, okay, in 10 years, I need $10,000. What do I need to put in every year to get $10,000? Obviously, it won't be the 10,000 divided by 12, because that wouldn't make any sense. So you would need to know small amount going in, multiplied over these 10 years, brings you to this final figure of an annuity. Make sense? So if your client comes to you and say, hey, I need my child to have 20 grand by the time it's like they go to college, what do I need to invest today and every year to get to that place? You would tell them, this is the product, this is the amount. If all else remains equal, this is the amount that I have in the future. But this is the money you will have for your child in the future.
If all else remains.
Everything remains, because when you study economics in school, you will always say that, yeah, all things remaining equal.
No,
Right? Pardon?
no.
Never. No, I mean, it could happen. I mean, you might have your 1 or 2 clinical situations, but it'll happen, right? You'll have your clinical situation every so often. So, but remember in our society as well, because of our stringent regulators, you won't have too many clinical situations. That was a one-off, kind of.
And that's those who they sell it or buy it.
They kind of lost their shirts. All right.
Even if so, no bank really has stable interest rates if they were looking to make make a savings within the bank.
Yeah,
Or mutual fund, and you have too much clients, they cut it out.
because y'all don't offer 5% anymore, right? See?
You get 5% on your savings portion if you have a loan.
If you have a
Built-in
loan,
Savings.
right? But I paying y'all already 12, I'm at 16%. 2016, right? You were in which part of Fidelity?
Business development.
Business development. So you're selling stuff. to everybody, you know?
I don't sell anything.
What does business development do?
So I work for a lot of small businesses. What I sell is merchant services.
I didn't even know you have commercial services.
Really? Card
Yeah.
machine. $10 per month. You have a business that you need to sign up.
I actually do, but
Why not Fidelity?
this is where you come. Sorry.
We
This
build
is where you come.
relationships, okay? Build relationships.
Oh, they get you brainwashed. I got you. All right.
No.
So 3 loan payments. Don't feel bad. I worked at I started I started Commonwealth, but my longest banking career
Was
was
that
at
Fidelity?
Fidelity Bank,
What's your chip on
main
your shoulder?
branch and Wolf Road.
What's
And
your
then I
chip?
ended at audit. I know, I love Fidelity. I love it. I just didn't know that I know that, but I was there. They weren't too much in the business.
No,
banking.
no, we just,
Yeah.
they
I know,
just
yeah.
started 2017,
See?
and I only
Yeah.
been there but a year and a half, so.
Right. And when I was there, that would have been 20. For 2 years. So that's kind of back to 2020. And then I was at, then I was at Scotiabank 2015. Then I was at Central Bank for 2013. So I was at Fidelity at 2012.
For how long?
5 years. No, I lie. Yeah. Yeah, 5 years. 5 years I was at Fidelity. Some of my best years actually. All right. So 3 loan payment methods. When you have a discount loan, what kind of loan is a discount loan? Just really a refresher for your test next week, because I ain't changing the test, so just let you know. Was it discount loan? No, no. You pay off the principal and all the interest at one time at the
And
maturity. All right, so there's one bulk payment at the end. Interest only loan, of course, as the name infers, you only pay interest over the life of the loan, and then you pay your principal at the end. Of course, an amortized loan is what you're used to, when you're paying off your interest and your principal
at the same
over time.
Yeah.
All right, so that's what that, I mean, basic, that's just theory that you would need to know, and then you work that like that. All right. That's what your exam will be on. Chapters 1, 2, 3, 4. Ken, do you have any questions for us?
just what we would have covered, right? Not the entire job.
Oh, I'm good.
You sure?
Yes, I was following when the ladies were doing the examples on the board and I did them in my book also, and I got the same results.
Perfecto. All right. If you have any questions, please let me know. Hopefully you're doing well enough, but you don't have to come in next week, but hopefully you're doing well enough to do the exam next week. If not, just let me know.
Okay.
All right. Have a great one. Thank you again for joining us.
Okay.